Okay, well, welcome to session 5 of Nuts and Bolts and New Ventures. My name is Joe Hadzima. I'm your guide through this trip through entrepreneurship. And to help our speakers tonight understand the context, let me just review with you and with them where we've been. On night 1, I did an introduction to New Ventures, talking about the various questions and issues you need to deal with as an overview if you're an entrepreneur. It was followed by Bob Jones, who did a great talk on finding your customer and the importance of customers. If you don't have a customer, you don't have a business. The next night, we had Rich Kibble with business models. With Bob, you learned how to create value. With Rich, the question was, could you capture some of that value so you could do it again? Then we followed up with a panel on people issues hosted by Habib Haddad, a great last-minute panel put together there around the issues of people and motivation. And then the next session, we had the Founder's Journey with Ken Zolot, where we got to talk to some entrepreneurs in the midst of what they're doing, covering a whole bunch of issues there. Then I had a session on legal issues, inundated you with all the legal stuff. And then Bob Jones came back and talked about presenting your venture, and in fact, presenting anything, really. We talked about how do you pitch potential employees and partners, etc. And he was followed up by Mindy Garber with negotiation skills, who did an interesting negotiation workshop online. And that brings us to tonight, which is going to be all about financing. In part 1, Julianne Zimmerman is going to talk about financing sources. Where do you get the resources to execute on the venture plan you put together? Julianne, like all of our presenters, has broad experience in new ventures from many perspectives, both as a entrepreneur herself, part of entrepreneurial teams. She's been teaching it. She's also currently managing director of Reinventure Capital, which invests in companies led by Black, Indigenous, and other people of color and women entrepreneurs. A very timely place to be investing, given where we are in society today. The other thing that she doesn't like me to talk about necessarily is she was 2 times almost an astronaut. So with that, Julianne, I'm going to turn it over to you, and thank you very much for putting this on for us.
Thank you. And Terno or Sam, can you free me to share screen? Oh, there it goes. Never mind. I'm good. So tonight, I'm going to spend this first hour with you giving you a sense for how to think about funding, not what kind of funding you should have for your enterprise, but how to think about what kind of funding. And I just want to start off by acknowledging that under the COVID pandemic circumstances of the past year, a lot of things have shifted. All kinds of businesses, not just startups, have had to rethink their revenue models. They've had to rethink their customers. They've had to rethink even their products and services. They've had to rethink their supply chain. They've especially had to rethink their capital access and needs. And so a lot has shifted in the past year, but the fundamentals have really not. The fundamentals remain the same. And so what we're going to talk about for the next hour is really how to think about the funding you are best suited to utilize for your enterprise. And so the most important thing to remember is that there is no single right answer. There's no a priori best kind of capital for young growing enterprises. And there's no one size fits all. It's really about the best, not only kind, but kinds, plural, of capital that will be effective for you to grow your enterprise. So I apologize for this graphic. It's a terrible quality. However, what I like about it is that it gives you a sense of not even all the kinds of capital you might explore, but a kind of representative sampling. And particularly when you look at the vertical axis, the y-axis, investment cost is the time that it takes you to pursue, secure, and service that capital. The attention you need to divert from the other activities you could be spending your attention on. The actual terms of that capital, whether you have to repay it and at what pace and with interest or with other kinds of repayment terms, or if you are in fact is in essence selling a portion of your company in the case of equity capital. So when you think about the kind of capital you're going to need for your enterprise, it's really important to understand what your objectives are, because each of those kinds of capital has an intended use, it has an intended time scale, and it has specific costs, again, both in time and money and equity. So the most important thing that you can do as founder is to be super clear about how you will determine what success looks like. You're creating this enterprise to achieve aspirations that you are setting. And so rather than being pulled into someone else's definition of success or finding yourself making decisions on the basis of capital you have taken, rather you want to make decisions that influence the kinds of capital that you pursue. And again, you want to be as concrete and specific as possible about what success will mean to you. It will look different from one founder to the next and from one sector to the next. And so as you think through how you will define your success, it really will be helpful to you to be able to determine the most appropriate and most affordable, the most cost appropriate forms of capital. That's not just how you will use the money, although how you will use the money, how you will spend it is part of that. But more importantly, what will that money enable you to accomplish? How will it enable you to get closer to your objective, your definition of success? And so plenty of people will happily tell you, and many of them very authoritatively, that what you need to do is X, and the only right way is Y, and that everybody else Z. Everyone has an opinion about what they think is best. But again, as the founder, you have the unique privilege and opportunity and burden to figure out what is best for your enterprise. So I'm pretty sure you've all seen the video that is that Joe has shared with you. It's on the Nuts and Bolts website by Kauffman Foundation that outlines some of the most common sources of capital for young growing companies. If you haven't watched it, I encourage you to find it on the Nuts and Bolts website and watch it, maybe at the break, maybe after tonight's session. It's admittedly, it's a bit dated and honestly, it's kind of schlocky. It's not my absolute favorite animation in the history of filmmaking by any stretch, but it does a passable job, I think, of at least giving you a sense of the kinds of capital that are most commonly used by founders and the rationale associated with each of those kinds of capital. So in the next few minutes, we're going to just dash through again some of the most common. It's by no means comprehensive, but I want to give you a sense of again, the flavor that each kind of capital carries with it. So let's start off with venture, because that's the one that is most front of mind for most people. It's the one that is overwhelmingly most discussed, and you would not be at all unique if you have formed the impression that it's the only kind or the best kind of capital for young growing companies. I've met many founders who didn't even realize that there was any other kind or that they had other options. It's so universally discussed in business press and in entrepreneurial circles. But the key thing to understand, and the reason I've used this image here, is that VCs are often either lionized or demonized, as the case may be, because they have a very specific set of objectives that may or may not align with yours as a founder. So venture capitalists basically raise money from individuals, from foundations, from pensions, from all sorts of entities, with the obligation to repay that capital with a return in 10 years. And so once a VC makes an investment in your company, first of all, that starts a clock. And depending on where you are in that 10-year cycle, that clock may be very short. It might only be a couple of years before they are going to harvest that investment from your company. So timeline, there's a timeline. There's also a return expectation. And so depending on where you are in the portfolio, there may be more or less pressure to make that return. And also, VCs, not only, it's not a secret, they don't only make a practice of having only a few of the portfolio companies generate that return, but it's something that they often tout, that there's a majority failure model in their investment portfolio. So you also want to understand who is the person you're working with at a particular venture firm, and how invested are they in the success of your company, in you as a founder. Because if they only expect 1 in 10 or 2 in 10 or maybe 3 in 10 of their investments to be successes, how much effort are they going to put into helping you to be successful? There's also, as a kind of subcategory, or you might think of it as an adjacent category, there are corporate venture or strategic venture practices. They tend to have less of a time and return objective, but they tend to be much more interested in the decisions you make about how your company grows in their sector. And so they'll have strategic and operational and market specific expectations that they may want to bring to bear. And they may or may not actually be terribly helpful to you as you grow the company. They may or may not have a whole lot of helpful advice and guidance to offer, again, depending on that alignment. If you are best served by venture capital, that is not to say you shouldn't go that path. It's just to understand that there are very specific expectations and structural constraints that you should go into with your eyes open. You should also understand that that a venture relationship is often described as like a marriage, and that analogy has some rationale to it. It has some basis in fact. It's a very intense, very intimate, and legally binding relationship. Depending on the duration, it might be a few or many years. And so, you are going to be in very close interaction with somebody who is a venture investor in your company. However, it breaks down, the analogy of the marriage breaks down in the sense that here in the US, as in many other countries, but particularly here in the US, if you have an unhappy marriage, it's messy, it's painful, it's expensive, it's terribly disruptive, but you can divorce. You cannot divorce your venture investor, whether it's a VC or strategic, you cannot divorce them. However, depending on the terms of the investment, they can remove you from your company. So there's a very significant power imbalance there. And so you also want to understand that going in, and you want to make sure that if you pursue venture capital, that you make sure that you are aligned with the person specifically you're working with, the fund or the strategic or corporate practice they're working within, and the timelines and other expectations they have. Angel investors, are less often demonized, but they are also in the main investing for returns. And they tend to be, but are not exclusively, individuals investing their own money. But they also, in the main, and there's a very wide range, in the main, they are also looking for a significant return. And they're generally, again, wide range, but they're generally anticipating that you will go down the venture path, that you will take a subsequent round of venture capital investment. So again, it's really important to understand whether the person or the group, the angel group in some cases you're talking to, shares your timeline, your objectives, your definition of success, and whether their investment objectives align with your plan, your strategy, your aspiration for the company. It's also really important to understand that it's simply a fact that the venture capital community is overwhelmingly white male, and about 90% of venture capital dollars go to straight white US born men from about a dozen universities. MIT is one of them, pretty high on the list. And moreover, the majority of that capital is concentrated in a half dozen metropolitan areas. Boston is one of them, again, pretty high on the list. So what that means is if you are not a member of all of those categories, you can expect that it will likely be harder for you. It'll be more time consuming. It'll be more effort. It'll be more no's until you get to an investor who is aligned with you and is going to back you and your company. And so again, that is not to say you shouldn't go down that path, but you should be aware that that's the case. And again, go into it eyes open. Is for any investor, you always want to look for, for any founder, you always, if you're pursuing an outside investor, you always want to look for someone who has a track record of backing businesses like yours and founders like you successfully. And you really want to do your homework on those investors. Talk to the people in their portfolio. Other founders are your peers. So look at their portfolio. Venture firms and angel groups typically post them right on their websites. Call up the CEOs. Ask them, what was it like working with this group or this particular firm? What was it like before they invested? What was the negotiation like? What kinds of things did they care about or press on? What kinds of things did they pay attention to? What has it been like after the investment? How have they been as an investor? What has that relationship consisted of? How have they been helpful? How have they not been helpful? And the more you can understand about who is likely to be aligned with your success, the more likely you are to have a happy equity investor relationship. And again, keep in mind that when founders and investors clash, usually the investor wins. So it's not a battle of equals, even though you are the one bringing the value and they are investing in your enterprise because of that value. Nevertheless, just be aware that it's not an equal playing field. So in addition to venture and angel and equity investment in general, there are government grants. These include PPP recently, which again, unfortunately, is unevenly distributed, and Small Business Association or SBA loans. They also include grants, outright grants that do not have to be repaid. And for those of you who are developing technology-based enterprises, whether those are related to health or information technology or communications or any number of a host of other sectors, materials, etc., there is very likely an SBIR, that's Small Business Innovation Research program, that is relevant to your business. And these are grants which you apply for. And if you are funded, the government awards an initial phase, a phase one, that ranges from agency to agency between 75 and I think the highest are like $300,000 for basically a proof that your innovation is credible to be commercialized to address that particular technology challenge. And then a subsequent phase, which ranges from, I think, 750K to, I think the largest ones are now a couple or 3 million, again, depending on the agency and the program, to actually begin to move that technology innovation out into the market. These, again, they are not repaid. They're outright grants, and they're often referred to for that reason as non-dilutive funding. That means they don't reduce your ownership or dilute your ownership of the company. And so they're not free. Remember, we talked about that y-axis of cost. It takes time and for sure, not only applying, but also managing that grant is time consuming. But again, if that is aligned with your objectives and it enables you to move forward with your enterprise, that can be a really great source of capital. People are often concerned about their patents or their IP, their intellectual property ownership. The SBIR programs, Small Business Innovation Research, are structured such that the government has basically a free license. So they are able to contract with you without further negotiation, but you own your IP. So you don't have to worry about that also being a cost of that program. If you are operating an enterprise which is revenue generating and has repeat revenues, you may find that a bank loan is actually a very attractive source of capital, particularly a revolving credit loan that enables you to access capital to smooth out your cash flow. So these are particularly appealing, again, where you have a company that is generating regular revenues, ideally that is profitable, and where the very low interest rates enable you to access capital as a working capital as opposed to investment capital. And again, unevenly accessible, I'm sorry to say, but we're talking about these facts, and so you may, if you are, again, a person of color, or if you are operating your business in another market other than those half dozen most invested municipal regions, you may find that your best access to capital is through a cooperative or a credit union or a Native owned or Black owned bank, where they have they have a strategic interest in investing in up and coming enterprises in their service area. So again, it's worthwhile to do your research to understand who is a good capital partner for you if that's a path that makes sense for your enterprise. Customer capital is a category that is rarely discussed in entrepreneurial settings, which I find astonishing, because if you are developing a product or platform or service where your customers will be keen to gain access to that very quickly, and particularly if they have an interest in customizing the features of your product or service or platform, you can frequently form a contract relationship with those customers to have them pay for the development of the features that are specific to their needs. This is often referred to as NRE, or non-recurring engineering, but it's also just broadly referred to as customer finance. And also, if you are able to sell your product, service, platform, what have you, on an advance basis, so in other words, your customers pay up front before you deliver, then that also gives you a better cash flow, obviously, right? And finally, if you have customers who are actually willing to pay you on advantageous terms, maybe not all up front, but maybe partly up front and partly very quickly on invoice immediately or within 15 or 30 days, that also smooths your capital needs. I want to give you a kind of just blanket caveat that very large corporations very often will have payment terms that are standardized at 90 or even 120 days. And some of them routinely expand or extend those terms, so they might not pay for 180 days or even longer. This is completely, in my opinion, it's completely wrong. It's in violation of the agreed upon terms, but they know that they have power over small suppliers and vendors. And so it's a routine fact that they will finance their operations on the backs of small enterprises. So you want to be super careful if this is an appropriate avenue for you to go, to make sure you understand how a particular customer routinely operates with companies like yours. So again, always in any of these instances, you're going in eyes open. If you are really good at business plan competitions, at pitching, if you've taken Bob's tips to heart and you are an outstanding communicator, and again, if it's appropriate to you and your business, you can find that there are some business plan competitions, the MIT 100K among them, that not only provide capital, but also a significant amount of profile and credibility. And so, again, depending on your enterprise and your success criteria and where you are in the process, you may find that it's worth going through competitions to bring in capital and to attract other supporters, whether those are customers or investors. Again, as in all the other categories, it's not free. It takes time. There's by no means any guarantee that you're going to take home a check. And there's a very wide range of prizes. So they range from hundreds or thousands of dollars to hundreds of thousands or even millions for some of the really fat purses. But again, there's time involved and there's no guarantee of success. If you are super fortunate to have someone in your life you might categorize as a fairy godmother, a wealthy family member or friend who is able to basically just write you a check for, thousands or more of working capital or investment capital, that is spectacular. Again, if it's aligned with your objectives, and even more importantly, if you and that person are super clear on your individual, your respective and your shared expectations. So what is this person's expectation in terms of getting the money back? Do they need the money back at some point in time? Do they expect some kind of financial return? Do they expect some kind of credit? Do they expect to be part of the story? Do they expect to be part of the decision-making process? And whatever those expectations are, if you have alignment, if you have such a person in your life and they are, perfectly aligned with your expectations and your objectives, then make sure you document your agreement. Do not make the mistake of having a verbal agreement on a handshake or a hug, or even under COVID, a wave, because that's a recipe for hard feelings. And the cost in this case can be a ruined relationship. It's a simple matter of human communication dynamics that each of us in conversation with someone else is carrying an internal narrative of what we think the conversation is about. And so very often you will have people who thought they were in agreement say, but wait, when you said blah, 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 I thought you meant this. And I've been expecting and I've been waiting and that never happened. And, or I said this and I meant this, but you took it to mean something else, right? This is a very normal human thing. The problem is when you have this kind of disconnect with someone who's very close to you, who has given you some investment capital or a loan, as the case may be, and you have that mismatch of expectations, it can ruin all of your Thanksgivings from this day forward. and unfortunately, that does happen. So, the cost in this case is a personal cost and an emotional one, and it can be really high, and it can have, of course, knock-on effects on other relationships. So again, if you have that opportunity and if it's aligned with your business and your goals, just make sure that you have a very candid conversation, very concrete, and that you document what exactly you are agreeing to, ideally with a lawyer's help, but at minimum, an assigned document that you both keep copies of. The most common way by far, even though we hear overwhelmingly and almost exclusively about venture capital, the most common way founders build their companies is bootstrapping. And bootstrapping essentially comes in two forms. The first form is revenue-based growth. So growing at the pace at which you are able to generate sales or licensing fees or consulting revenues or whatever it might be, right? So as people pay you, you grow the company. This is not only key for brick and mortar enterprises, but it really is the way the overwhelming majority of companies launch, and some very, very large enterprises have been grown this way. There's a famous example, a few of them now, but Sarah Blakely, who created Spanx, very famously complained that she could not get a VC to give her the time of day when she was trying to raise money, because that's what she thought she needed to do to grow her business. She was never able really to convince anyone to give her capital on anything approaching acceptable terms. And so she ended up, as she said, owning $1 billion business. Not a terrible outcome. The other, remember I said there are two kinds of bootstrapping. The other kind of bootstrapping is essentially keeping your day job, right? So the premise of building up sweat equity for many founders is simply a classist fantasy that you would be able to forego having an income for some period of time, 6 months to 5 years, let's say, depending on the business and the sector. That's simply unrealistic for most people, for most founders. And so keeping your day job while you grow the company in your off hours is a very common approach and a very effective solution. Again, particularly if you are growing a company that makes sales as opposed to a company that is, say, in the pharma space, right? Where you have very big capital needs and no revenues in the near future. So again, based on your objectives, based on your business, based on your circumstances, bootstrapping can be, in fact, the most capital appropriate way for you to build your business. Specifically for managing cash flow, you may find, and many founders do, that using your own credit is very effective. This is really good for very short timescales. So not for investing in the business, but for, say, if you need to purchase supplies or you need to pay for travel or other things, but you're not only going to get paid for those expenditures within 15 to, say, 60 days at a stretch, preferably 15 to 30 days, right, within the repayment cycle of the credit card. Then that's a really efficient way to access that capital because you can just recycle that credit month to month. Where it becomes super hazardous is where people max out their credit cards with the expectation that they'll pay them back in 6 months or a year or 2 years. And that is, that is a recipe for bankruptcy, which I absolutely would not want to see any of you undertake. So again, it's a question of aligning the capital and its attributes with your business and your needs. The takeaway from all of this, and again, this is just a sampling of the most common forms of capital. There are many others. But the takeaway I'd really hope that you carry home with you away from this Zoom tonight is that a dollar is not a dollar. There is no a priori right answer for how companies should be capitalized. And that really you want to think about the form of capital that, again, is most suited to your needs at the stage at which you're seeking it. And in any particular business, you may have different phases and different uses of capital for which you have different kinds of capital. But also that, again, it's not just how you spend it on hires or operating costs or marketing or product development or other categories, but what it enables you to do to advance your business towards your success objective. And again, keeping in mind that over the life of your business, you may use multiple kinds of capital, but you want to match the cost and the shape and the timing and the terms of that capital to your uses, not shoehorn your company to fit the capital. So how do you do that? It's really all about the questions you ask yourself ultimately. Again, what is your objective? What is your success? What will your company look like when you have achieved your aspirations? How will you measure that? What will that be? And how much money will it take to reach that aspiration? Will that money be needed at a particular point in time? Will it be needed in a lump sum? Will it be needed as a recurring or cyclic flow, like a line of credit? Or will it be needed at certain points in stages? And again, what will that money enable you to do to get further along the path towards your definition of success? Which costs can you bear? And again, this varies from founder to founder and from business to business. Which costs, time, effort, attention, relationships, repayment terms, ownership of the company, decision-making rights, etc., which can you afford, and which can you offset by, again, either using revenues or customer finance to reduce your need for other forms of capital? Can you pre-sell your product or service so that it's paid for in advance of your expenditure of costs, so that you don't need to bring in capital? Can you find ways to reduce your operating costs? And particularly in our virtualized economy under the pandemic, what can you avoid having to do in person? What can you do at much lower cost? So again, your need for capital is reduced or is smoothed or postponed. And given the company that you're creating, what are the norms in your sector? Again, if you're growing a biotech or a pharma company, there are some very standardized norms for how that works. And so you're really not going to have a whole lot of latitude to work outside those norms. So understanding what those norms are enables you to, first of all, recognize the set of options available to you, and also to be able to talk to partners and funders and capital sources in a way which is knowledgeable and credible and authoritative. And so you have a compelling proposition to put in front of them when you seek capital, whether that's grant or investment or what have you. Depending on your objectives and the kinds of capital you believe are appropriate for your enterprise, are you willing to alter the priorities that you have in mind in order to be able to secure that capital? So again, let's say you have customer finance, you're doing a non-recurring engineering NRE contract. That may take you a little bit off your development objectives so that you are spending time paying attention to your customers' specific needs. How much of a diversion can you afford? How much time, how much focus can you divert to that customer in order to maximize the value of that relationship and not pull you completely off course from your objective? If you're bringing in an equity investor, how much ownership and how much control are you willing to exchange for their capital? And how much value are they bringing besides capital in order to help you be successful? And what resources can you draw on? What network, what educational connections, what community connections, what peer resources? Again, all other founders are your peers. So what peers can you call on? How can you think about all of the resources you have at your disposal to help you to identify and prioritize and secure the capital that is most conducive to your purposes, your success, your enterprise? And this is not a one-time process. This is not an exercise you go through, now as part of nuts and bolts, and then you're done. This is a process that as founder CEO, you will be evaluating and reevaluating in most cases over the life of your company. Even as your company becomes quite successful, you will still be thinking about what is the most appropriate form of capital to enable my company to continue to succeed and thrive. So we're going to skip over a couple things because I actually just want to focus on leaving time for Q&A. And I want to just, again, reiterate that the most important thing you can do as founder CEO is be rock solid clear about why you are creating this enterprise, what success will look like in very concrete detail, how you will know if you have achieved your aspiration, and how you will measure that success. Because that is how you will be able to make strategic decisions, not only about capital, but really about everything else. And then just in the same way as you've heard about building a team, you want to be every bit as disciplined and focused and strategic about securing that capital as you are about building your team. You want to build capital and other resources around you, which are aligned with your success, which are conducive to your success, and which ultimately are going to reduce the confusion and other costs that you would go through if you, again, like the Cheshire Cat or George Harrison, didn't choose the path you're on, but you just go down whatever path is in front of you. So you want to create the conditions that will actually produce your success. So I know this has been a real whirlwind, and it's kind of a shotgun blast that I've thrown at you for the last 45 minutes or so. But I wish all of you every possible success, and I am I'm, as Joe knows, I'm a quite visible contributor in the MIT community and the entrepreneurial community at large. And if I can be helpful to you, which is by no means a foregone conclusion, but if I can be helpful to you, I'll be happy to. And so I think with that, we should have at least 20 minutes for questions. Is that right?
Yep, that's right. We have a question in the chat. Michael Jackness, do you want to come off mute and ask your question? Michael?
He said just read it.
Okay. Jen, you want to ask your question? You have your hand raised?
Well, any place is a new place at some point. If you follow that little T, you never have any drugs.
Oh, who is that? Let's see, that's not me.
Yeah, but I do it intentionally, right?
Getting some
Just didn't have more
feedback here.
Okay, I'm not sure who's talking.
Yeah.
I'll happily take a swipe at Michael's question. Michael asked a couple of questions. First of all, is it a problem to be dependent on a specific loyal customer for a good long while? How do you answer the textbook lectures that this is bad? So in answer to that first two-part question, one loyal customer can be a really high-risk proposition just because it's very brittle. So if you have one really great customer and that customer is really aligned with you and is, a very profitable customer and a very consistent customer, that's wonderful. However, there are all manner of exogenous factors like a pandemic, for example, that may cause that customer to change their strategic priorities or not be able to pay you, right? And so having one customer is just simply a very brittle proposition. And the second question was, what if for soft or humanitarian reasons you don't or can't see an eventual classic exit strategy, envisioning a stable operation going forward? Again, this is really the crux of why I advise that you are super clear about the business you are creating. The overwhelming majority of businesses do not have a venture structure. They are not venture backed and they don't have a venture exit. So, we tend to almost mythologize or even fetishize venture capital as though it's the only or the best way to grow an enterprise. It may be the exact right way to grow yours, but it's not a foregone conclusion that that's the right answer. So for companies that are not going to be venture backed, again, there's a host of other kinds of capital, and we touched on several of them that are likely to be better aligned to your purposes. Okay. Who's next?
Jen, you can ask your question.
Yeah, thank you so much for your presentation. Maybe I missed this in your coverage of the topic, but what are some typical terms, length of time of repayment and fee or carry for these venture capital investments? I know it's a very general question, but just some ballpark idea.
Sure. So just structurally, it's good to understand that a venture fund typically has a 10-year life. So depending on where you are, where the fund is, I should say, where the fund is when you encounter them, they may be at the very beginning of that 10 years, or they may be halfway through, right? And that's going to have a huge influence on how quickly they are going to be looking to harvest their investment and their return, right? That's often referred to as an exit, or on the founder's case, a liquidity event. But the point is, you may have very little say in that timing. So you want to understand where they are in the fund. Most venture funds do not have an interest-based or repayment-based model. They have an exit-based model. That differs significantly from, say, family offices, who, as direct investors, may have a more revenue-based model. They may prefer a cash return as opposed to an exit. And they may not have the same kind of time horizon sensitivity. So individuals and family offices, again, vary enormously, but they may not have the same constraints because they're not operating within that fund structure of a defined term, right? It's always appropriate when you are talking to any investor or any capital source to ask them detailed questions about their expectations for time, for return, for the kind of return they're looking for the constraints or the conditions under which they might force a return, right? Because you are going into a binding financial relationship. You want to ask every question you can possibly think of. And by the way, if somebody pushes back on you and says you ask too many questions, walk away.
Thank you very much.
Sure. Who's
Sophie
next?
and John.
Thank you. Thank you, Julian. I have two questions. The first one is about diversification of funding. As we're doing, this whole pandemic and COVID-19, the diversification of supply chain, et cetera, is really prominent. And we also had experiences where, a deal fall through because, the company said, oh, we did not get the funding. So I want to understand, is diversification of funding add the complexity of it, or should we always think about that? The second question is, I'm trying to develop a financial projection for a pitch deck, and I don't know how much details or research I have to do. Trained as a scientist, I want to make sure that all the data can be backed up, but that result in a lot of research, and I don't know, how much research I need to do in order for it to be sufficient.
And I also have a follow-up question on when to pull the trigger, but we get to that after that.
Okay, all right. So
sorry.
All right, so let's roll that back. So if I understood your question about diversification of funding, very much like I answered the question a moment ago about having a single customer, I think having a single source of capital is also brittle, right? Because again, even if it's a great source of capital, even if they're well aligned to you and their terms are exactly what you want them to be and everything, nevertheless, as we've seen over the past year, all sorts of exogenous factors could hazard that relationship, right? So I encourage you to think about all of the kinds of capital that are going to be conducive to your success, and not be too dependent on any one, and particularly any one party, right? In terms of making a financial projection for a pitch deck, that does vary a little bit from sector to sector, and for sure it varies a bit with stage. But what I encourage founders to do always, regardless, is to substantiate as much as you possibly can. So if you don't yet have your own numbers, in other words, you don't yet have any sales, you don't yet have any customers, you don't yet have any actuals, as they're referred to, right? Then use the norms of your sector, right? And be prepared to talk about why you have reason to believe that you can either conform to those norms, right? Comparables, right? Why you should be able to do that, or conversely, why you believe you should diverge from those norms, and why that is an appropriate thing for you to do, right? And again, knowing the norms, knowing what is well accepted and well established in your sector will enable you to present that in a way which is authoritative and compelling and credible, right? But always, as a founder, always you want to be truth testing everything you're projecting, right? I know people who have driven themselves into bankruptcy by living on their projections, right? Like, we project a 30% success rate on our sales in this channel, and we project a 60% success rate on our sales in that channel, which is marvelous. But if you're only hitting 20 and 30 respectively, that's not going to work, right? So go with the best model you can substantiate, right? And again, substantiate that with third-party comparables if you have to. And as soon as you have evidence, flesh it out with your own actuals. Yeah? And what was the follow-on?
Basically, right now we're doing a lot of bootstrap. We have a real product and a chemical process. So we're doing a lot of new science. And so every week I make progress in the science with just little pockets of time. And so I'm wondering, I'm building value in the company by doing this, but I'm also waiting for somebody else to figure out something cooler. So when do I know when to pull the trigger? I'm like, okay, this is ready to go because we built value. There's a hard balance between I know I can build more value in my company, but I also can blow it on someone else coming up with a better idea.
Yeah, so again, this is a question that is only answerable on an individual basis, right? So what can you afford? I mean, I don't answer the question.
Yeah.
Like, in all seriousness, like, what can you afford? Like, could you afford to go without an income to pursue this proposition for 3 months, 6 months, a year, whatever, right? And what would you need to do in order to be able to do that?
Mm-hmm.
Right? Could you secure grant funding to cover some of those expenses, right? Are there ways that you could make it possible to be a full-time endeavor, right? But the fact of the matter is that I can't answer that for you, and nobody else should, honestly, because you are the only one who knows the answer to that. It's also, I think, really important to say this is my time horizon, and not to run yourself over the cliff, right? If you can afford, let's say, 6 months of runway, then give yourself decision points along the way, right? At 2 months, how's it going? Am I on track? At 3 months, like, okay, how's it looking, right? At 4 months, do I need to find a job? Right? Because, you know, you don't want to really do the Wile E. Coyote thing and go sailing off the cliff edge. You want to live to pursue it, right? And if you have to go back to pursuing it as a side endeavor while you make some more money, okay, that's all right. It's not anybody's first choice. Once you've committed to go full time, it's not really your first choice to go back to doing it part time. But if that enables you to move forward, then that enables you to move forward, right? And that's a form of capital for your business.
Thanks.
Cheers. Yeah.
Harpreet?
Thanks, Julianne, for such an incredible presentation. Just to check, can you hear me?
Yes. Yeah, I hear you.
I was curious about the intro that was given about you, that you invest in Indigenous-led businesses, because I've never heard that before. And
yeah.
but I would love to hear about, you know, what is your investment thesis around that? And
Sure.
I might have a follow-up question based on that, but thank you.
Yeah, so I'm, as Joe said, managing director and a GP, which means I'm a partner in Reinventure Capital, which is based here in Boston, and we invest exclusively in US-based companies that are led and controlled by BIPOC, that's Black, Indigenous, and other people of color, and or female identifying founders that are at break even and poised to grow profitably. And every single one of those is a requisite for us. So we have that focus because, first of all, we see that it's an economic and social imperative to address the steep and persistent asymmetry in access to capital, which drives wealth inequality and also drives a skew, let's say, in what innovations actually get funded and find their way to market. But we also see that again, severe hyper concentration of capital leaves open an enormous and robust and really vigorous opportunity set that our mainstream VC peers just don't seem to be able to perceive. And so it's for us both an impact and return objective. The predecessor fund on which Reinventure Capital is based had a majority success model. 2/3 of the companies in the portfolio returned the fund return. And of the remainder, about half at least returned capital. So only about 1/6 of the companies were write-offs. And the fund returned 32% IRR, which for those of you who are not acquainted with VC is quite good. So for us, it's a both and proposition. we see, again, BIPOC and female identifying founders as not only an under competed and under served and under invested category of entrepreneurs, but we also see them coming up with simply different, interesting, compelling commercial propositions than the, again, the usual suspects, so to speak, who are much more readily able to access venture capital. So our investment thesis and our investment strategy is about system change, but it's also about opportunity and return.
Great to hear. Thank you.
Sure.
Kelsey?
Hi, can you hear me okay?
Yes.
All right. My question was around whether you have a better chance of getting funded by VCs depending on what you're going to use that funding for. So if like there's an inherent tend to shy away from like product development over marketing, for example, or if it just all comes, if it's not that simple and it all just comes back to like, where are you in the stage of your company? But if there's any sort of like things kind of tied to that, like at the surface level.
Yeah, so I don't think there's a simple answer to that question. First of all, different VCs have very different strategies and very different approaches. And so, for example, if you're talking to a venture firm that has a focus on consumer products versus one that has a focus on, say, enterprise software, they're going to have very different priorities in terms of what they perceive as the necessary figures of merit and progress markers, right? So they're going to have quite different priorities and expectations. And again, that's where it's so important to know what the norms are in your sector, right? That said, I think it's again really important to know not just how you will spend the money, the use of funds is, how you'll spend it, but also to be really clear in articulating what that will mean in terms of advancing your business. And given that VCs are essentially investing in a future return, they're basically buying a future return. You want to demonstrate that if somebody invests, let's say, $10 million in your company, that will enable you to achieve the milestones that will justify, a $50 million valuation before you need to raise capital again, or whatever is the norm in that sector, right? So you want to be able to tell a story which is about building in the outcome that they are looking for and proving your credibility to do that. So just a quick aside about that, when you are giving an investor pitch, no matter who the investor is, a venture investor or a strategic or a family office or an individual or an angel, doesn't matter. You are essentially doing two things simultaneously with that pitch. And they are inextricable from one another, but they are different things. The first thing is you are telling the most compelling, credible, authoritative story you can about why this business is exciting and why you are the right person to lead it to success now, this instant, right? Today. That's the first thing. Why is this a compelling business and why are you the right person to make it happen right now, right? The second thing is why it's a great investment for them. And that's about telling the story about how the future performance of the company fits their investment objectives, right? So if you tell those two things in an authoritative, credible, substantiated way, right? So that you're telling the story that fits their interest, you're going to have much higher likelihood of bringing in those investors. the mistake a lot of people make is they tell one story and not the other, right? It's usually this one, but sometimes this one. Or they tell the wrong story, right? So they're talking to an investor who is, focused on let's say a 3x return in 2 years time, and their business is, maybe a 5x return in 10 years time. I don't care if it's a bigger return. It's not my time horizon, right? Wrong story, wrong person, right? So you need to get both of them right, and you need to tell them in a way which is, again, well substantiated, super credible, and compelling.
Thank you very much. I appreciate it.
Yeah.
One last question from Michael Jackness. What is the relationship between various funding sources and different levels of liability insurance protection you might need?
Oh, goodness. I don't even play an attorney on television, so I'm going to stay very far away from that question. Sorry. I'll let Joe answer that.
Sounds good. That's the last question, and we are right about time for our 5-minute break.
Okay, before we sign off, everyone, thank you all very much for your attention. Thank you for your questions. I sincerely wish you all every possible success. And for those of you who are members of the MIT community, I'm sure you've heard this from Joe and others, but I can't possibly recommend too highly the venture mentoring service. The MIT Venture Mentoring Service is open to everyone in the MIT community, faculty, staff, students, alumni. It's free, and the mentors are bound by their obligation to the VMS to give their very best objective advice without any conflict of interest. So you get really spectacular, high value advice from people who have all manner of directly relevant experience. And that is one of the resources, as I mentioned, that you can draw on to help you build your company and to manage the costs and your need for capital.
Excellent. Thank you. Thank you, Julianne. That was excellent presentation. In the past, you've done a panel, and that's been interesting. I've never seen you do a complete presentation on the subject, and I thought it was just fantastic. So
Oh, thank you.
thank you on that, and good pitch for VMS.
Yeah. In all seriousness, there's the joke I often make about it is that the value is very, very high. The cost is 0. So you divide by 0. It's arguably an infinite value for your investment. So well worth doing.
Right, but you do have to do your homework. They don't just tell you what to do. They help you figure out what you need to study to figure it out. So
and they don't do it for you.
That's correct.
All right. Thank you all very much.